Lease. Meaning, a lease. Now we will discuss the different types of lease. Meaning, a lease refers to a contractual agreement between two parties where the owner of an asset, the lessor, grants the use of that asset to another party, the lessee, for a specific period of time in exchange for periodic payments. Types of leases. Financial lease. Financial lease is also known as capital lease, a means of financing capital equipments. A financial lease is a lease that transfers substantially all the risks and rewards incident to the ownership of an asset to the less, though the lessor is the legal owner in substance. Title may or may not eventually be transferred. It is the alternative to own funds, bank credit, and borrowing, through the issue of debt securities. According to AS 19, whether a lease is a finance lease or an operating lease depends on the substance of the transaction rather than its form. In financial lease, the asset is leased for a long period. Generally, the time duration is equal to the economic life of the asset. Economic life is either the period over which an asset is expected to be economically usable by one or more users, or the number of production or similar units expected to be obtained from the asset by one or more users. This lease is non-cancelable in nature, and at the end of the lease period, the lessee has the option to buy the asset. The AS 19 defines a non-cancelable lease as a lease that is cancelable only upon the occurrence of some remote contingency, or with the permission of the lessor, or if the lessee enters into a new lease for the same or an equivalent asset with the same lessor, or upon payment by the lessee of an additional amount, such that, at inception, continuation of the lease is reasonably certain. Thus, in the case of a finance lease, the entire risk incidental to the ownership of the asset and the benefits arising from the use of the asset are transferred to the lessee except the legal title, which may or may not be eventually transferred. The lessor transfers the ownership of the asset to the lessee by the end of the lease term. The lessee has the option to purchase the asset at a price which is expected to be sufficiently lower than the fair value at the date the option becomes exercisable, such that, at the inception of the lease, it is reasonably certain that the option will be exercised. The lease term is for the major part of the economic life of the asset even if the title is not transferred. At the inception of the lease, the present value of the minimum lease payment amounts to at least substantially all of the fair value of the leased asset, and the leased asset is of a specialized nature, such that only the lessee can use it without major modifications being made. Indicators of situations which individually or in combination could also lead to a lease being classified as a finance lease are: if the lessee can cancel the lease, the lessor's losses associated with the cancellation are borne by the lessee. Gains or losses from the fluctuation in the fair value of the residual fall on the lessee, example in the form of a rent rebate equaling most of the sales proceeds at the end of the lease, and the lessee can continue the lease for a secondary period at a rent which is substantially lower than the market rent. Operating lease. A lease is classified as an operating lease if it does not transfer substantially all the risks and rewards incident to ownership. Both AS 19 as well as IAS 17 define operating lease as a lease other than a finance lease. An operating lease is a lease in which the period of lease is short when compared to the useful life of the asset or the equipment being leased. An operating lease is mostly used to acquire assets on a relatively short period basis. For instance, an aircraft which has an economic life of 25 years may be leased to an airline for 5 years on an operating lease. The lease period being short, the lessor will recover the cost of the asset from multiple lessees. They are typically for assets like computers, windmills, and so on. In operating lease, the lessor is responsible for all kinds of maintenance, insurance, and all other expenses related to the leased asset. Sale and leaseback. In this type of lease, the owner of an asset sells that asset to the lessor and then gets the asset back on lease from the lessor. The purpose of the leaseback is to free up the original owner's capital while allowing the owner to retain possession and use of the property. A sale and leaseback can be beneficial to both the buyer as well as the seller. The seller gets a lump sum of cash quickly, which improves the liquidity, and the lessor gets the benefit in terms of tax credit and a flow of regular income. The sale and leaseback arrangement is popular among companies which are facing short-term liquidity crisis. Oil and Natural Gas Commission, ONGC, undertook an international sale and leaseback agreement with 10 Japanese lessors, led by Sumisho Leasing, for an equipment owned by the ONGC, aggregating $60 million. The payment terms were fixed at a rate of 10.5% with the amount repayable in 14 equal semi-annual installments, following a grace period of 6 years, so that the aggregate lease tenor extended to 13 years. The ONGC simultaneously swapped the fixed-rate borrowing with a floating interest rate so that the cost of funds was reduced to 60 basis points below LIBOR. Leverage leasing. Under leveraged leasing arrangement, a third party is involved besides the lessor and the lessee. The lessor borrows a part of the purchase cost, say 80%, of the asset from the third party, that is, the lender, and the asset so purchased is held as a security against the loan. The lender is paid off from the lease rentals directly by the lessee, and the surplus after meeting the claims of the lender goes to the lessor. The lessor, the owner of the asset, is entitled to a depreciation allowance associated with the asset. Close and open-ended lease. In a close-ended lease, the asset gets transferred to the lessor at the end of the lease contract period, whereas in an open-ended lease, the lessee has the option of purchasing the asset. Upfront and back-end lease. In an upfront lease, higher lease rentals are charged in the initial years and lower rentals in the later years of contract. Whereas in the back-end lease, in the initial years, the lease rentals are less but increase in the later years. Percentage lease. In the percentage lease, the lessor needs to pay fixed lease rentals plus some percentage of the previous year's gross revenue. 3N lease, net and net leases. In the net and net leases, the lessee is responsible for maintenance, insurance, and taxes of the property. Cross-border lease. In the cross-border or international lease, the lessee and the lessor are situated in two different countries.